Alright, Best Buy a few days ago reported weak earnings, and let's take a look at this New York Times article. Hurt by slower sales of smartphones, Best Buy has bleak holiday results. A slow smartphone market and aggressive price cutting by competitors have struck at the heart of Best Buy, the largest electronics retailer. The company on Thursday announced bleak sales during the all-important holiday season, sending its shares tumbling nearly 29% and sharply reversing momentum the company had gained in previous quarters. The shares gained in after-hours trading. Best Buy's revenue was $11.45 billion during the 9-week period that ended January 4th. That was down from $11.75 during the holiday period a year earlier. And then it goes on by saying that with many consumers using the internet to compare prices in seconds, many retailers try to drive up unit sales by lowering prices. Those tactics by customers or competitors are what Best Buy said hurt the company the most. Domestic comparable store sales fell 0.9% in the last quarter compared it with a year ago. Hubert Jolly, Best Buy's chief executive, said that deep discounting among competitors made the company answer one question: do we make the incremental investment necessary to be price competitive and defend our market share? And then it goes on and on and on, and they talk about how smartphone sales were weak. But I think there seems to be a common theme that many other companies are reporting, first of all, terrible earnings when it comes to some of these retailer companies. I mean, let's go on later in this article. Best Buy is just the latest company to release disappointing holiday results. Many companies reported little to no growth last year and have lowered their profit forecasts. Holiday earnings from some companies, especially Sears Holdings, have been dire. Sears reported that sales at its Sears locations in the United States dropped 9.2% over the same period the year before. And if you want to look at what's going on, especially with the retailers, this is when the stock market went up. What was it, like over 25%? And we see some of these stores getting hammered when it comes to their earnings. And I reported that there's going, or what I thought in my head before the break, or right around earlier this year, that there could be potentially a bloodbath in earnings. And for some retailers, I was correct. Maybe not for all these companies, I was wrong, but for some of these retailers, they are reporting horrible earnings right now. And we could take a look at why I came to this conclusion. Okay, now look at this. This is the numbers that I gathered out from the St. Louis Federal Reserve website. And as you can see, there was a doubling in private inventory numbers. And if you look at it over here, if you see a spike in inventory numbers, then what does that mean? It means that consumers, not consumers, but businesses felt that the economy was recovering. And when they feel that the economy is recovering to the extent that people say they are, then they may start to buy a lot of goods because they think that they could sell it off. And you usually see inventory levels go up when the economy starts to improve. But if you look at what's going on right now, the businesses need to liquidate all of those inventory numbers, or all that inventory. And if consumers are weak based on some of the sales that we've seen based on the results at Sears, and if you want to look at Best Buy, and there are a few other companies that are missing on earnings, then this could potentially be a problem. If the economy were growing, then these inventory numbers would be liquidated. But if the inventory numbers stay flat, then the firms will have to have discounts in order to make sure that this inventory is indeed liquidated. So this is one of the problems that I see coming forth, maybe for this quarter or next quarter. And let's look at what's going on with earnings in general this quarter, or for the fourth quarter of last year. Okay, here's an article on Reuters, and it says U.S. companies miss earnings forecast more than usual so far. If early reports are an indication, more U.S. companies may be missing the mark on profits this season than investors have become accustomed to. It's still early in the game. Results are in from just 10% of the S&P 500 companies so far, but 50% have missed analyst earnings estimates compared with long-term average of 63% for a full reporting period. What's more, the average beat rate, as it's sometimes called, have been higher in recent years, averaging 67% for the last 4 quarters, the data showed. For the first 52 on the clock, this is the worst start in terms of beats in about 2 years, said Nick Rich, CEO of the Earnings Scout, an independent research firm specializing in earning trends. His research showed that 70% of the first 52 S&P 500 companies to report results have been beaten or have beaten earnings expectations since the first quarter of 2012. Improving trend on the revenue side may more than buffer that weaker snapshot on earnings, however. And then it goes on and on and on. But anyways, we do see potentially a shift in many of these companies missing earnings. We shall see whether this trend continues and whether I was correct in not forecasting, but just me thinking that some of these companies or a lot of these companies would miss. Some of the retailers have thus far, and we shall see. Alright, thanks for listening to me, guys, and I will talk to you later. Bye.